Good afternoon and welcome to the latest Equifax Fraud Trends webinar. My name is Carl Davis and I head up the Fraud and Identity teams here at Equifax Canada. Today's session will be split into two segments. Firstly, we will take a look at some of the fraud trends we saw during the first half of 21. The second portion of today's event will be a panel discussion, and we've gathered some members of our fraud consulting team who've graciously agreed to share some of their insights and opinions on key topics. With me today, I have Priyanka Parakarma, Tiberius Forrester, and Francisco Leonelli, who are all ready for some lively discussion. We should have some time for Q&A toward the end of the session. However, time can get away from us. If that's the case, I would ask you still pose your questions to us. If we cannot answer them live, the team will be more than happy to get back to you offline. Before we get started, I'll hand over to my colleague Sandra, who will briefly cover some housekeeping items for the webinar today. Sandra.
Good afternoon, everyone, and thank you, Carl. Each area within the platform is responsive, so you can maximize or minimize each widget or box based on your viewing needs. Our presenters are on camera in the media player on the left side of your screen. There is an Ask a Question widget that Carl mentioned just under that, so feel free to enter any questions you may have, and we'll address them throughout our session today. In the event there's too many questions to get through, we'll generate an FAQ document, which we'll send out to you in the coming weeks. Our presentation today is available in the Related Content widget for downloading on the left, and bios of our speakers appear on the right. Slides will show in the middle of your screen, and the French presentation will be available in the next few days. Today's webinar is being recorded, and you will receive the on-demand link via email tomorrow. We have a short survey, which we'd ask you to fill out, and that will automatically pop up at the end of the webinar. You can access it also by clicking on the survey icon at the bottom of your screen. To the right of that survey icon is a Contact Us button. Please send us an email if you'd like further information, and a team member will be happy to help. Now let's get started. Carl, back to you.
Thanks, Sandra. So, I'm not really sure how everybody else feels, but I'm kind of tired with the new normal. We seem to have a new normal for everything these days. I asked my 7-year-old about how her school cohorts recessed to limit interactions with other classrooms, and she confidently told me it was her new normal. It was pretty fun. The only real constant we see, though, today is change in our environment, in our perspectives, and our behaviors. And we've been forced to change through the pandemic, and we have to know and expect that fraudsters will adapt to. What we're seeing around attack vectors, seasonal trends, target verticals is challenging our expectations and the assumptions that we've held so long. We have to be ready in order to protect our business. Before we get into some of the details of the presentation, I wanted to start off with a polling question to gauge some audience feedback. Promise we don't have too many of those, but they are peppered throughout and we found them really valuable last time. So, polling question number 1. What verticals would you say are the most vulnerable to fraud in this recovery period? We have a couple of options there. I'll give everybody just a few moments to respond. Okay, I think we see some answers coming in. So yeah, makes sense. The banking industry is certainly one that we have seen previously be very much targeted for fraud. We'll all recall in the previous webinars we've talked about some of those deposit account frauds that happened in response to the government stimulus packages. Certainly expect those to continue for a little while yet. The small to medium-sized business is an interesting one, and I think maybe that's something we can pick up as part of the panel topic later. Now, before we get into some of the heavy details around our fraud charts, I wanted to spend a little time looking at market conditions. For anybody who didn't catch the Equifax Credit Trends webinar last week, I would highly recommend reaching out to your Equifax team to get some details, really insightful stuff. The inquiries index you see on screen sets a good starting point for the fraud trends we're going to tackle. And what's shown is a simple depiction of credit inquiries by quarter indexed to Q1 2019. Now, we can see a typical trend until we have that gray segment, which of course is our peak pandemic period. But after that, we're back to a typical growth slope. So this indicates that consumer sentiment for credit is getting back on track after that significant dip in early 2020. This is generally supported by a number of signals across the data spectrum we see, including some of the fraud slides we'll cover in just a moment. However, as a word of note, as we see increasing demand for credit, there are some other signals that indicate we need to take a cautious approach to risk. Sort of high geographic variations in recovery, uncertainty around government stimulus and interest rate risk could have an impact on the consumers, which could increase the risk we carry and potentially drive up fraud. Let's take a quick look at overall volume and some of the corresponding fraud rates for 2021. The chart you see on screen shows the extraordinary 2020 position shown in the grey columns, which indicate application volume, and the grey line indicating fraud rate. The red markers indicate our 2021 position. And so a few observations we can make when looking at this chart. Firstly, volumes are generally stable through the first half of 2021, with that sort of exception of that spike in March. And yet, despite that spike, we don't see the expected dip in fraud rates. The actual fraud rate itself is lower than 2020. This is expected given that relationship between fraud rates and volumes. Volume is higher in 21, as we saw from the credit demand graph just a few moments ago. Also notable is the stability of the fraud rate throughout the first half of the year. In fact, when looking across the consortium, we're actually seeing fraud rates lower than we did in 2020, 2019, and part of 2018. So I guess we can assume that fraudsters are taking a breath? Maybe not. Let's quickly review the split of fraud between first and third party. The chart on screen now shows total applications in the grey column, with first-party fraud rates in the red line and third-party in blue. Very quickly, we can see that first-party fraud outstrips third-party fraud by some margin. Now, this is typical based on historical data we see in our fraud platform, although not quite to the same scale. Certainly, 2020 was exceptional for third-party fraud, but since Q2, the trend has been fairly muted right up until Q2 of 21, when we see a significant jump. In fact, that blue line rises 72% between March and May alone, putting it right back on par with first-party fraud. During Q2, we saw growth in cards and banking sectors within the third-party column that's actually driving much of that increase. First-party also shows an interesting trajectory. Q1 saw significant increases after sort of expected low volumes around Q4 2020. As we move into Q2, we can see the fraud rates start to deflate. Much of those early increases in first-party fraud were again related to those personal deposit accounts. So looking back to our first polling question, yeah, we were right. That deposit account or banking area certainly was a target at that time. And this is a trend that we can actually see carry over from last year when, again, there was significant momentum in fraud with that particular product. Always a good barometer of where fraud is taking place are the reasons or types of fraud that are attached to the records within our platform. Now you can see from the two charts on screen, True Fraud ID continues to be the dominant and growing quarter over quarter. Suspicious email, although shrinking in Q2, is actually significantly up when looking back at this time last year. In fact, if you were to go back a few years, this type of reason would be lucky to break into the top 5, and yet here we are now at least in second place for both Q1 and Q2. Suspicious IPs, another reason code that falls into that category of showing notable growth, but a few years back wouldn't have even been within the top 5. Now, lots of what we're observing here in terms of fraud reasons are due to the new digital channels that are opening up across all product lines. Walking into a branch, you may not have needed an email, but every online app will. This is a clearly observable measure of the fraudster's push into digital channels. Just to further illustrate that, let's spend a few minutes on the table to the right of your screen, which shows those types or reason codes, and specifically the ones that have the highest percentage increase between January and June 2020 and that same period in 21. Suspicious email has a 210% growth, which is clearly huge. And then the next one, 133% increase in synthetic ID. Both of these are clear indicators that fraudsters love and are attempting to exploit those digital channels, which have become the key point for our businesses to connect with consumers as we go through the pandemic and as we continue coming out of the pandemic. Let's now take a quick look at some fraud trends by industry. The data so far has covered the consortium in its entirety and gives us a good sort of indication on overall fraud activity within that Canadian ecosystem. So now we'll spend just a little time looking at the patterns within specific verticals. Often gives us a really good insight into what is happening in that particular vertical and how the fraud landscape differs between those industry segments. Let's take a look at the banking segment first. You'll recall from our last webinar, this segment incurred some of the largest growth in fraud rates, driven primarily by increases in deposit account fraud, again related to the government stimulus programs. As we move the analysis into Q1 and Q2 of 2021, we can see that application volumes are relatively stable with some minor variability in March. However, as fraud rates continue to be among the highest we've seen across any industry, in fact, the peak in March represented the highest single-month fraud rate for the banking industry since before the pandemic, even with the backdrop of increasing application volumes. So that's a clear indication that banking continues to maintain that previously identified trend of increasing fraud centered around deposit accounts. We posited previously that though the driver of the SERB fraudsters were likely, that through the driver of SERB, fraudsters were likely to be in control of more deposit accounts than ever before, and we believe that that could actually be the jumping off point for some additional fraudulent activity, and that trend does not seem to have abated through Q1. Now, we do observe some deflation in fraud as we move into Q2, which brings us back to the closer to the typical rates that we've seen for this industry, still high, but actually more like the typical areas. Again, True ID fraud actually accounted for over 35% of all fraud that we saw in the banking sector between Q1 and Q2 of 2021. Moving over to cards, we see similar volume variations as we did in the banking space, but interestingly here, there's a reversal of the fraud rate curve. So Q1 saw increased volume and fraud rates in March, for example, and as volume has flattened through Q2, the rates of fraud, as expected, rose and brought us back into typical fraud levels that were observed before the pandemic-related variability came into play. So what this could mean is that fraudsters are now turning more of their attention back to the old faithful card space and away from the banking segment, as maybe the COVID stimulus packages change. What we do expect, however, that as volume continues to normalize and hopefully start showing some of those normal growth signals, the rate of fraud will once again normalize and track closely to the expected seasonal trends. But of course, as with all of these numbers and expectations, the unknown impact of COVID must always be taken into consideration. Fraud rates in the telecom segment have shown some stability in the first quarter of 2021 after the high levels of volume and fraud rate variability throughout 2020. As we can see from the chart, volumes in Q2 have shown some level of growth, especially around June, and the response in fraud has been one of continued and higher expected fraud rates. June 2021 shows fraud rates that were not seen since the end of that peak pandemic period. A few other items come to mind when thinking about telco. We talk a lot about increasing digital channels, but telco specifically has been a segment that historically had a fairly strong digital presence that was well tested and battle ready. This could be the reason why changes in fraud for this segment have not been as pronounced as others. However, nobody's fully immune, we know this. And some interesting details on this segment was the growth in fraud types. Fictitious ID, being cited as a fraud reason, has increased some 330% when comparing January to June 2020 versus that same period in 21. In that same period, true identity fraud is also up 125%. So really material numbers here. The types of fraud are changing in this. So the auto industry has been in the headlines recently with chip shortages, for example, affecting new vehicles and subsequent knock-on effect within the used car market. From a fraud perspective, we can see some variability in volumes through the first half of the year, but with the general trend pointing toward growth. The fraud rates in Q1 followed the expected trend given the spike observed in March, but as we move through Q2, we can see some much more stability in the rate of fraud and a generally increasing trend of fraud rates. Throughout the pandemic, I would say the auto industry has demonstrated stability in fraud rates, probably more so than any other vertical we track. However, we do expect that fraud rates will increase as we continue through the remainder of the year, especially with the backdrop of potential supply issues in this space. Moving on. So mortgage. So let's take a quick peek at this segment. We're certainly back in the grip of a very heated housing market with demand significantly outstripping supply. As we look through the end of Q1 and into Q2, we can see jumps in application volume. The rate of fraud associated with that volume did not dip as much as expected in March and April. And if we look at May and June, we can actually see a significant increase in the rates of fraud, even when application volume is reducing slightly. So this is interesting, and it may be indicative of some targeted behavior by fraudsters. Even with the fraud rate reduction in June, it is still above the expected levels compared to volume. We're landing on numbers now that were high even for pre-pandemic times. Let's try and look at this data in a slightly different way. This chart you see right now shows the month-over-month changes in volume and the month-over-month change in fraud rate for Q1 and Q2 2021. We know that rate and volume should typically show an inverse relationship. Application volume goes up, all else being equal, with the assumption that fraud is a relative constant, fraud rate should actually drop. Where we don't see that pattern is where we can infer some targeted behavior. And we can see quite clearly on the screen that during February and March 21, rates of fraud increased quite substantially, rates of application volume increased substantially, as did the rate of fraud. The same behavior can be observed in May. Drops like we see in June typically indicate a return back to typical expected rates in this month-over-month chart. And so we can see that quite obviously, mortgages became a target for fraudsters in that first half of 2021. Now, we mentioned that telco was a vertical that had sort of existing digital presence before the pandemic. Mortgages, on the other hand, have made that shift in more recent years, buoyed on by the pandemic itself. New segments that get online quickly become a target for fraudsters, and so it's not really surprising that we see the bad guys taking a shot here. However, there's one really interesting data point that surprised me. Looking at the total rates of fraud and separating them out between internet and non-internet applications, we can actually see that for the mortgage vertical, the rate of fraud for internet-originated applications is actually lower than that of traditionally originated applications. So as an example, in June 21, the rate of fraud for mortgage internet-based applications was 0.18% compared to 0.67% of traditional mortgages. Now, of course, granted volumes are lower, but the delta between those two rates are material. What's also interesting is the rate of fraud for those internet-originated applications are growing. We said that June was 0.18%. If we look back towards the start of the year, those rates were 0.09%. No other segment that we track shows this type of inversion. All follow the expected path that the internet-based applications have marginally higher rates of fraud compared to the overall fraud rate. So what this means in practice is there's an interesting question, but we can assume that this would be a good place for fraudsters to start pushing fraudulent applications because that significantly below average rate for the internet-based applications could provide them some digital camouflage. Okay, on to our panel segment of the webinar. As mentioned at the start of the session, we're lucky to have a few members of the fraud consulting team who are going to provide us some insights. You should be able to see their welcome and faces on screen right now. So joining me today, we have Priyanka Parakarma. Priyanka leads our pre-sales consulting practice here at Equifax Canada. We have Tiberius Forrester, senior consultant within our fraud and ID pre-sales team supporting government, telco, and insurance. And Francisco Leonelli, senior consultant, fraud and ID pre-sales supporting our Quebec-based clients. Priyanka, Tiberius, Francisco, welcome. Very happy that you're able to join me today, and I promise not to venture too far off-piste with my questions. So, first question, and maybe Priyanka, I'll get your observations on this. What are some of the downstream, either positive or negative impacts of the rapid digitization that we've seen in the past year or so?
Thank you, Carl, for that lovely welcome. And hello to everyone that I can't see, but I wish I could be in front of you in person. I think the current development of the digitization in the financial services industry is more more so than anything, evolutionary rather than disruptive. I mean, we were already in the process of ramping up when the COVID pandemic hit, and circumstances created by the pandemic only supported that growth furthermore. However, I think it's important for us to distinguish between those, industries that really benefited from this rapidly developing digital wave versus those that are, I would say, still in the process of getting themselves fully amped up. So as an example, if we take a closer look at the fintech and small to medium services industry, this was an industry that was able to reach a much wider audience since their primary method of engagement is now considered widely normal. However, they also encountered a lot of stiff competition because a lot of the big boys in the industry are now playing pretty vehemently online. And so they had a much stronger digital presence as well, whereas initially they pretty much had the digital market cornered to themselves. Another example would be the automotive industry. The automotive industry has largely been, over the decades, a largely brick and mortar business. And they still continue to be that. I mean, you still walk into a dealership to purchase a car for the most part. But we did see, with the restrictions put in place and the dealerships shutting down, that the automotive industry really ramped themselves up and focused on having a more digital presence, figuring out methods whereby they could, remotely complete the paperwork and the adjudication process for lending, as well as being able to hand over the keys to a car at a more safe location that wouldn't, impact essentially their customers and wouldn't expose them to a heavily populated environment like a dealership. That being said, though, I think all industries across the board are looking to enhance their digital offerings by modernizing their consolidated back-end systems, as well as creating more user-friendly front-end systems. And I think that's just a trend that we're going to keep seeing. I mean, everyone in the industry is competing against giants like Amazon and other, largely digital-based vendors who have perfected this method. And all of us, those are largely brick and mortar, are now catching up. I think something you alluded to earlier in your conversation was the mortgage industry. And I think that's a noteworthy sector of business because that industry has seen so much innovation to be able to facilitate, the entire mortgage lending process online. And prior to the pandemic, it was almost entirely paper-based. You had to be at a broker, in front of a broker, or you had to be at a branch office to be able to actually buy a house. There was a lot of paperwork involved between, your agents and your lawyers, etc., which has now all been digitized. And that is leaps and bounds beyond where that industry was situated prior to. And there are some excellent examples of that we can talk about if we had more time. But what I did want to sort of also reiterate is that something, Carl, you said earlier is every industry that is innovating right now or is sort of opening themselves up to a more digital process is also by consequence, opening themselves up to a larger, broader risk for fraud. And the fraudsters usually have a pretty small window of opportunity that they consider a sweet spot where they can really, really capitalize. And it's before the consumers actually adapt themselves quite comfortably to the online presence and the online process and identification, etc. So what they do is they take advantage of all the consumers, they take advantages of the businesses that are kind of, finding their legs in these processes, and they try and reap as much benefit as they can during this period. And I think that's sort of where we are right now. So as an industry, as an organization, we just need to be a little bit more cognizant that, we are potentially going to be targeted. So when I say we, I mean the financial services industry in general. And we can really learn from the credit card industry that really took to heart the entire online transactional model and put safeguards and practices in place much earlier on because they were such a heavily targeted industry traditionally. And now they are, despite the fact that transaction volumes spiked quite substantially during the past year and a half, the fraud rate for this industry was relatively calm, and it didn't actually see that much of a hit. So certainly lessons learned, but it's an exciting time to be in the financial services industry, and I'm sure the fraudsters think the same.
Yeah, thanks, Priyanka. It certainly is an interesting time. The one question that always strikes me is, obviously we're bringing these digital channels and digital services out so that clients and customers, our end users, actually can still maintain that connection with us and start applying for services. But I'm interested, how that is perceived or taken by consumers. clearly, I think different demographics and different comfort levels with, for example, applying for a mortgage online. When I first bought my first house, that would have been unthinkable, but now it's kind of part of the course. Maybe, Francisco, I'd be interested in your opinion there about how this changing demographic might have a bearing on consumer sentiment.
I believe the consumer sentiment was sincerely nurtured from the very beginning, because we had to adapt to a digital need, because I believe we truly felt the need, in the sense that if we go back, I don't know, 10, 7, 5 years ago, some people were very reluctant to do certain things digitally because there was a very alternative way. That alternative way was the traditional way, the one we're comfortable with, the one we're used to. Very, very important keywords in defining human behavior. And the pandemic shattered that. All of a sudden, in a certain way, we really truly felt the need for some digital processes, and we appreciate them and we benefited from them. We saw the value that they can offer. Of course, there's going to be a normalization because those traditional alternative methods are going to come back eventually more and more to the norm. But there's no new normal, as you say. I mean, physically, it changed. It truly did. And in a very practical sense, I mean, we hear many experts saying that this pandemic actually was a catalyst, was an accelerator, that it actually pushed us forward in the digitization 5, 6, or 7 years. So very practically speaking, what it means is that many organizations are today, in 2021, facing the challenges relating to digitization that they would have usually faced in 2026, in 2027, or in 2028. But you're facing them today with today's resources, with today's tools, with today's solutions, and with literally 5 to 7 years less as a reaction time. They're not incredibly complex problems. They're incredibly critical, urgent, and current problems. And those parameters makes them very complex to solve.
Yeah, thanks. I think part of your answer that resonated with me was much about behavior and comfort. Again, our environment shapes our behavior. Certainly during the pandemic, people's general comfort and their behavior changed quite significantly, as did all organizations in the financial industry, and by extension, therefore, fraudster behavior also had to change very quickly as well. And so, yeah, I agree. It's an interesting time with that mix of behavioral change, different comfort levels. I think we certainly saw the effects of that as fraudsters took advantage. I'd like to move on to a polling question back to our audience now, which I think should be up on your screen in just a moment. The question: how do you see digital channel use changing in the next 12 months? We're certainly coming out of the recovery period, and so for example, I can go back into the corner store and buy a lottery ticket now, but there's an expectation that there may be changes in the digital channel. I'm interested in how our audience feels about that. I'll give everybody just a few minutes to respond. Just a few more seconds to get some more answers submitted. Let's take a peek. So you can see generally the balance is in the higher end, the significant increase or very significant increase in fraud. And I certainly tend to agree, without a crystal ball that tells me what's going to happen with COVID and what responses we may have, I do think digital channel usage is here to stay. So yeah, I totally agree with the sentiment, the general sentiment from the audience that this truly is our new normal, and I can't believe I actually used a new normal phrase again. So moving on to our second panel question, we talked about consumer behavior and what we're doing. I think interestingly that we need to consider is what we're doing as an industry. And so the question I have: how can we as an industry continue to support the digital transformation while also safeguarding the interest and experience of those consumers? Maybe Tiberius, I can ask you to take a first pass at that.
Yeah, thank you very much. And I'm definitely glad we got those answers in the polling question. Otherwise, I think most of my answer wouldn't resonate with our audience. Really, Equifax, we've been at the forefront of this digital identity space for, I want to say over 20 years now, working with both the private sector and governments to ensure that we can accurately and securely identify people in online interactions, non-face-to-face interactions. And I'm glad we all agree that digital is here to stay. And honestly, Equifax should be sharing and leveraging this wealth of knowledge and experience in the interest of consumers at large and really of other companies as well. Now, I know I've said that we've been at this for 20 years. In no way does this mean we should rest on our laurels. A lot has changed the past few years, and honestly, we need to continue to innovate. We need to remove as much friction from the identity process as humanly possible, while, of course, maintaining that security and accuracy aspect that we've come to expect.
Yeah, thanks. I appreciate it, Tiberius. And you're right. And Francisco, I wanted to turn it back to you again, actually, because your recent answer about how the consumer sentiment might have changed. I'm interested in what you feel that we can do as well to safeguard consumer interest so that their sentiment actually improves. Any thoughts or comments?
Yes, and it's going to be a similar answer in the sense that if we take a step back, I truly believe that the only way to continue anything, but to continue anything in a context that has changed or even drastically changed, you need to adapt. There's sincerely no other answer to how can you continue, is you need to adapt as quickly, as intelligently as possible. Just to quote Darwin's going to make me sound bright in here, but adaptability is truly what defines survival. And when reaching the same goal as before is your objective and your landscape has drastically changed, you will require to show adaptability. And it's important to keep in mind that the actions that we do, I mean, the objective of those actions is to reach a certain goal. So if or the actions change or the landscapes change, but when one does, the other one has to follow. It is in moments like the current period, moments requiring great adaptability that will sincerely give an edge, that will give an advantage to one side or the other. I mean, the first side that will adapt intelligently and efficiently, the first one to do it quickly and well, will win an edge, will win an advantage over the other one, until that second one catches up or dies trying. What I truly believe that this highlighted very clearly is the weakness. Sincerely, that's the term I want to use. It's the weakness of PII. There was a moment where PII was complemented by human sense, in the sense that you looked at an ID with the name, the address, the date of birth of an individual, but you had the individual in front of you. You were actually using all your senses to ask yourself, if this makes sense, how do I feel about this? So in a digital context, we cannot rely on that. And the equivalent, the digital equivalent for that is metadata, data that you can use on top of the traditional PII elements. Things like device reputation management, passive authentication. I truly believe they're going to be a great part of the solution. Equifax has physically acquired Count earlier this year precisely to be able to provide, well, what digital identity management requires. So how do we continue to support? We adapt. We have to humbly accept sometimes that what was working before is not the best way of doing things now, and I believe we're doing that.
Thanks, Francisco. Yeah, I agree, and it's interesting. We sort of talked a little bit about sort of identity management, and it's interesting actually because what we've seen certainly a lot of certainly in Ontario and other provinces is around how that identity management that consumers will be able to use and leverage and consent and be in charge of is actually changing at the moment. So I think this actually leads us quite nicely into the next question that we have. Another polling question for the audience, but I believe this is the last one, I promise. How big of a role do we see the government playing in enabling or deterring fraud in our economy in the upcoming years? And fraud and identity go hand in hand, and there's a lot of information out there right now about how governments want to play a role in that identity process. So I'm interested in this group's thoughts on that. So I'll just give everybody a few minutes to respond. we got? So actually, this one's more interesting to me. Actually, there seems to be, certainly the balance within the sort of positive side that governments will have a big play. But I'm interested. We still have maybe a higher area in the insignificant role than maybe I expected. So that's interesting. I think we should maybe talk a little bit about that as we go through. And Tiberius, I'd like to come to you as our resident government expert in the fraud pre-sales team. What are some of the measures that government can put into place to support Canadians, as we move through this rapid pace of digitization?
Yeah, perfect. Thank you. And very, very interesting polling results. I personally believe that government has a super important role to play in shaping the future. And truly, this applies to all levels, whether it be at the federal level, provincial, and municipal. We all agreed a couple of minutes ago that digitization of identity is here to stay. And, whether we're talking about driver's licenses or vaccination passports, or really the gold standard in the future will be access to government programs and services online, that digital experience will be key. And if we truly take a step back and look just at this pandemic, and we look at the initial rollout of government measures to combat it, they were very quick, and it was purely targeted at getting money in the hands of people who desperately needed it. And that sort of came at the expense of initial checks and balances. And that was a very logical step that the government took. Now, as we're working through our fourth wave and looking forward to the prospects of recovery and what we can do in the future, I feel the government will take a much more proactive approach to these programs. And I mean, digital identity, there's studies from all sorts of countries around the world where this has been used to a great success. And I think everybody points at Estonia. Really, what we've learned from this whole vaccination process is that the single greatest success factor is mass uptake of any program. So Estonia, for example, had their digital solution in place a year before it went live. Why did they wait? Well, they waited because an extra year gave them exactly 10 years after the country's independence, which meant that all their 10-year passports were due for renewal. And what Estonia did, which is a very pragmatic approach, was anytime somebody that year came with to get a new passport, they got a new digital identity card along with it. And that ensured that mass uptake. That was their inflection point. And I know everybody will mention that Estonia is a smaller country, and in Canada we do have the provincial and federal jurisdictions at play. But really, if we look at the current push for vaccine passports and how they're going across the country, we are at that inflection point that Estonia experienced. So if we do take advantage of this, I feel the federal government especially has a great role to play in making sure that there's federal standards for interoperability so that my Ontario digital driver's license can be used in Alberta or BC and vice versa.
Thanks, Tiberius. Yeah, Estonia is an interesting story. As I look closer to home, the vaccination passport's quite a polarizing position out there. Priyanka, just bringing it back to your area, having sort of visibility across the financial services sector, how do you see that interplay between kind of the government sector providing these types of services and the private sector?
That's an interesting question. So, as we gradually move to a more digital world of engagement with our consumers, we should try and learn from the different avenues that are or different areas of business actually that are quite successful in it. Areas like the social media sector, as an example. Let's take Facebook, that utilizes email credentials like Hotmail, Gmail, or Yahoo to be able to create profiles and to be able to verify their users. I think similarly, the situation we're in right now creates quite a large opportunity for really large banks in the financial sector, as well as the telecommunication industries, to utilize the reams of data that they have on consumers to serve as digital guardians. And what I mean by that is, in a very heavily regulated banking industry, as an example, there already exists so many processes and procedures that lend themselves to a robust framework and support consumer and commercial KYC. I say, why not have banks leverage that and extend the capabilities out to provide coverage to other small businesses that may not have these capabilities and may be able to avail of that. So having the banking sector extend these capabilities out will allow smaller, less proficient organizations to safeguard consumers' identities and also allow for a more trust to be created in the industry in general, and therefore enabling, a more rapid digital growth in a much more safe and succinct manner. It's not just supporting consumers, but also supporting vendors and merchants. A really, really good example of this is the CRA utilizing the triple blind model of authentication that Secure Keys Verified Me platform provides. They essentially leverage the capabilities of the banking network to be able to verify an individual's identity to then allow them to log in. Another really good example would be how Equifax is globally gearing up to build a more multi-point, robust verification process. I think Francisco alluded to that earlier, where he's talked about the account acquisition, but above and beyond that, other more passive methods of gathering data and actually creating a more robust profile of an individual whilst, not interrupting the actual interface process, I think is definitely the way to go. But if, we marry the government processes with the capabilities that the banking and the telecommunications industry have, we can certainly facilitate the digital undertaking of, verification and identity management in a much cleaner, much safer way for our consumers in general.
Thanks, Priyanka. Francisco, any thoughts or comments based upon the clients that you support?
Yes, and sincerely, I honestly agree with Tiberius in the sense that I believe that governments have a very great role to play. I sincerely also I believe I understand why 1 out of 2 in the audience would see it otherwise, because it's really a collective effort. The government is supposed to arm, I know it's a bad word, but it's supposed to arm the ones that will go and fight the fight against fraud. But the government is not necessarily the one fighting it, not necessarily in the first front or forefront, and not alone. I mean, in the financial industry, we really witness the nimbleness, the agility, the incredible adaptability that fraudsters had all throughout the pandemic. I mean, every different pandemic stage, they very opportunistically did the best that they could do. And it was a humbling experience to actually witness how efficiently they were doing it, how structured, how thoughtful they were in their approach, and that many organizations actually had a hard time following. And I truly believe that one of the elements behind that is a common misconception that a lot of people have about fraud. When we say there was 1,000 fraud cases or 100,000 fraud cases or 1.5 million fraud cases, it's very important to always remind ourselves that it's not 1.5 million individuals that just got up one day and decided to do a fraud each. It's going to be 1,500 individuals, doing 1,000 fraud each. It's fraud is organized. It's an industry. It's a business. Fraudsters have meetings just as we're having this one. They use machine learning just as our solutions do. They have artificial intelligence-based solutions. They share intelligence. They have consortiums. It's the exact same thing, and that is very important to keep in mind, that when we say the fight against fraud, it's not a bunch of individual variables that are by pure coincidence acting alike. It's a very organized machine. And yes, in there, the government, I believe, can arm us. And I saw one of the comments and the questions that was regarding, is that possible that peak in May for mortgages was actually, again, something very opportunistic, something related to the June 1st regulation amendment. And one of the points I actually had in my planned answer here was the June 1st regulations amendment, because that's a clear example of what the government can do. On May 31st, a credit file that was over 3 years old with matching information could have been empty and identify a Canadian individual. I mean, as simple as that. Right now, that credit file cannot be empty. It cannot have a single trade. It needs 2 distinct sources of information actively reporting to it. So definitely, that as a single regulation change must have instantaneously burnt about 30 or 40% of synthetic identities that are sleeping somewhere. So definitely, the government can help. But there's a big thank you to really the organizations that are listening to us right now, because they are the one making this fight daily.
And just to extend on the question that we saw, I'm not sure who the question came from, but it's an interesting one. We very much appreciate it. Do we think that just prior to that regulation coming into force, it would have spurred fraudsters on to try and use some of those identities that they realized post that time frame would not have been viable? Francisco?
I truly believe that yes. I truly believe that yes. And I believe it's, again, just another example of the timing, the structure, because we're not talking, again, one or two fraudsters that did one or two mortgages application. As you pointed out yourself in your trend analysis, it was a fairly substantial increase in volumes at the same time as a fairly substantial increase in fraud rates, which means that the nominal amount of fraud was nearly exponential in growth compared to the previous variable that it was compared to. So definitely, I would say yes, and very good observation.
Perfect, thank you. We've talked a lot about fraud and how sort of external fraudsters are taking advantage based on changing behavior, new digital channels, etc. But I'm interested to kind of flip that around a little bit. I've seen some reports recently about that kind of insider threat, and so a question maybe I'll pose to Tiberius. With lots of our clients focusing on external fraud, and rightly so, what do we think about, or what can be done to mitigate internal fraud or insider risk as well?
That is a great question. From a government point of view, my brain immediately goes to the case of Robert Hansen. And, for those of you who don't know your Cold War history, right off the bat, he was an FBI double agent who leaked secrets to Russia for 25 years on and off. Arguably the worst intelligence disaster in U.S. history, depending on how you feel about Robert Snowden. And he was almost caught multiple times. But he happened to operate at the same time as another gentleman called Aldrich Ames, who was, again, spying, but he was part of the CIA, and he got caught earlier. And that basically allowed Robert Hansen to continue undetected for another 10 years. It is really, really difficult to know how people will change over the span of their employment, over the span of their lives. There's psychologists who make entire careers of this, and I don't pretend to be one. But from an insider risk perspective, what this truly does point out is a huge need for ongoing and thorough due diligence, because the risks do change over time. And truly, the higher up in the organization or the more access to information and systems, the more damage that can be done by any one single individual. And again, that's not to say that everybody is motivated by money. In the case of Robert Hansen, it was. Ideology may come into play, but the old adage was, follow the money. It still applies, even if it is an ideological question. There's still money somewhere in the background. So following that, making sure that ongoing checks are there is really key. Everybody, Equifax included, governments included, has very thorough screening practices when they hire somebody. There's interviews, there's background checks, all of that. But those are truly point-in-time exercise. The continuous monitoring part is, I think, where things do need to go to. And obviously, this is not to say that companies or governments should take a big brother approach to monitoring everything I do or say, whether I'm at work or in my personal life. But sort of an ongoing confidence or coherence check to make sure that things haven't truly changed, or if things are about to change, there's employee assistance programs or there's help that the company can offer me before I become susceptible to a foreign agent. That is truly key to mitigating risks. I don't think anybody, and I hope Francisco's not going to come out and say that there's one silver bullet that's going to fix all of this, because truly I don't believe there is. But ongoing due diligence, I think, is key to this.
Yeah, thanks, Tiberius. I agree. I would like to bring Francisco back into that question, not to rebut your points. But again, I'm thinking back to behavioral changes and what we've had to live through the pandemic. how does insider risk change now that everybody's working from home? Like, I get at least the original point of initial screening as you bring, individuals into your organization is important. But do we think we've seen any change in the risk factors because now everybody is, accessing that information outside of company walls? Francisco, any thoughts there?
Yes, and don't worry, Tiberius, I will not contradict you. I perfectly agree. There is no silver bullet, and I believe that's part of the beauty of it because it makes it very challenging. But yes, to your question, Carl, I mean, insider's risk, right? The simple first word of that term implies that he was inside the same walls as your secrets are kept. Right now, the insider's risk are physically external to your walls. So definitely, I mean, the insider's risk became external risk. And it's just another example of digitization in the sense what we considered our perimeter as an organization, what we considered within premises, what we considered safe or tolerably safe, all of a sudden is not within our walls. So it's just another really angle on which we can definitely see a practical example of digitization. But yes, I mean, my answer would be that security is not a different concept than happiness or sadness or satisfaction or fulfillment. It's an overall concept. I'm going to betray my age here, but when I was growing up, there was this riddle that said, hey, you know what, there's a very important person in a car and that person got shot. Yeah, how come? I don't know. Was the car bulletproof? Yes. Were the windows bulletproof? Yes. Was he protected? Yeah, security guard on each side. Oh, then must be insider. I mean, was the driver on it? And no, it was a convertible. And you're like, oh, what's the point of all those security features? I mean, triple lock on the front door, but you leave your window open. So definitely, insider's risk is a variable in the big model that will actually define your security level. And just as anything related to security or happiness, you're going to lose a few battles. You just need to always make sure you win the main ones.
Yeah, that's an interesting analogy. I've never heard that, but I get the sentiment, right? You can't be almost secure, right? You either are or you are not. Exactly, that makes sense. Perfect. Thank you very much, Francisco and Tiberius, for the response there. So we're coming up towards the end of the session now, and so at this point, certainly like to open up for any questions that have come in from the audience. I certainly saw one just a moment ago, and panelists, please be prepped because I may pose some of them to you. One of the questions I saw was, what steps are we as an organization taking to combat synthetic ID fraud? I'll start off there, and maybe then Priyanka, I'll pass that over to you. Synthetic ID fraud is a problem, right? With lots of data being out there in the public domain, and as Francisco pointed out, fraudsters, really having access to the types of same tools and advanced technology that we do, the risk of synthetic fraud is becoming exponential. And so certainly a big risk out there. The challenge with synthetics, as always, is, at the first time you see something, how do you know it's synthetic? It could be new to credit, new to candor if you've never seen them before. It's actually a challenge to do that. But we are working on some initiatives internally that are going to help our clients try at least to look at and protect themselves from that synthetic fraud. So Priyanka, maybe, happy for you to expand on that slightly if you wish.
Thank you, Carl. I think at the heart of the matter, in order to be able to combat synthetic ID fraud, you need to understand synthetic ID fraud. And what I mean by that is synthetic ID fraud sort of hides itself underneath a lot of other layers of fraud. So you can have, a first-party individual committing fraud that eventually busts out, but components of the fraud that they've committed are part of a synthetic profile. You can have third-party fraud that has, aspects of it that resemble a synthetic ID file. You even have what we classify as part of doing business synthetic ID, and then you have the legitimate fraudsters that actually commit synthetic ID fraud. And what I mean by that is there are synthetic IDs that people who have bad credit or have bad reputations are unable to conduct business normally or unable to acquire credit normally. They assume synthetic IDs. They have every intention to pay. Is it fraud? Yes, it's fraud. Are they going to, go belly up and bust out, or are they going to defraud you in some way? Probably not, because they are trying to, live a better life, lack of a better way of putting it. But then there are other individuals who assume or build these synthetic IDs. They sell them on the open market. They groom these synthetic IDs. Alluding back to Francisco's point, yes, the June 1 legislation has made it slightly harder. But a lot of these people have invested a lot of time, effort, and money in grooming these synthetic IDs. So to be able to catch them, to be able to gauge them, and to be able to identify them and then be able to combat them is a largely uphill battle. On our side, what we are doing is we've come to realize that at an instance and point is not the way to identify a synthetic ID. You need to kind of be able to see where the profile of the synthetic ID is trending. So you need to gauge it from at different instances in time. So if we take an example and say, Priyanka has a synthetic profile and Priyanka has a credit file, well, what is Priyanka's behavior over a period of 6 months, 8 months, 12 months? That will lend itself to being at a higher risk for it being a synthetic ID versus it being, as Carl said, a new entrant into Canada, or a student that's just turned 18 and now has a credit file that they created because they've gone out and bought their first phone. So these kinds of measures, what we are doing on our side is observing. We are using, the data that we have. We're utilizing data that our partners have, as well as, experts in the industry to come together to create solutions that can service, the financial services and other industries as best as we can, but also in a more simplistic way, because you can't complicate matters so much that when you're sitting down to assess whether somebody is, a synthetic ID or not, and you're taking 25 minutes to do it and the boat has sailed and the process to actually adjudicate on the deal is gone. So you just kind of have to strike a balance there. But, I know we're running out of time, but I'm happy to speak with any one of our clients and partners who are on the call today and elaborate on these concepts. Always delighted to talk about fraud.
Thanks, Priyanka. And I think you're right. As we talk about it, one of the key areas that we're actually looking at, we're actually working on a solution, is actually the use of some advanced analytics and machine learning to drive that. Because again, it's actually complex and it's weaved into different types of fraud that we have. And so being able to look at some of those different clusters and how they have a higher propensity to be able to detect that type of fraud, I think is important. I do realize we're at time, and so I wanted to do one more question. So quick fire round. Each of the panelists, will start with maybe Tiberius. 30 seconds or less, most surprising trend that we've seen in fraud during the pandemic to date?
I would say for me, from a government point of view, is digital ID. And I'm going to use it. I'm a Senators fan. I live in Ottawa. It's not easy to admit this in public, but you know how Ottawa is always 3 years away from being 3 years away from competing? Well, digital ID was that. It was always 3 years away from being 3 years away. And the pandemic has moved and solidified the timeline, and it's going to happen much sooner than people were potentially expecting.
Perfect. Thank you. Francisco.
30 seconds. I would definitely go by how opportunistic fraudsters have been and how evident it is that we're dealing with against a very structured enemy in here. The digitization, I believe, has been the compelling event that will change quantitative fraud for many verticals into qualitative fraud. I truly believe the fact that there is less fraud, as you said, in last year than 2019, than 2018 partially this year, but yet the fraud losses and avoided fraud losses are already considerably bigger than any of those years. Fraudsters are literally doing more with less, which usually means you're doing it better. That would be my keep away from all of this.
Perfect. Thank you, Francisco. And Priyanka to finish up the session.
I think the most surprising trend for me was the rapid increase in synthetic ID. I think that at the beginning of the pandemic, we were poised to have that rapidly increase. We saw synthetic ID go up, but we never saw account takeover go away. We never saw other forms of fraud decrease. But just the rapid increase and the rapid formation of these synthetic IDs. I mean, we at Equifax have been conducting some quite large scale analysis just to gauge and see how many profiles do we have that could potentially fall within the reams or the realm of synthetic ID. And just the data that's been coming back to us is is something that I'm seeing. Like, I know there is a lot of synthetic ID, but I don't think we've seen the end of this yet. I think there's a much larger growth trajectory for synthetic IDs to grow and evolve, actually, to become smarter, cleaner, more adept profiles. So that's shocking, disquieting, and also on point and trend.
Yeah, I appreciate it. I think for me, it's I think somebody else mentioned it. It's just the agility or the dynamic way in which fraudsters can adjust very, very quickly. We all work for large organizations. We know change is not easy. The organization, I think we see it, some of the larger criminal enterprises, continues to surprise me. Perfect. So that concludes the fraud webinar today. I think we're just on or slightly over time. I'd like to thank everybody who took the time out of their schedules to join us today, especially my expert panelists. If I could ask the attendees to complete the survey that you will see shortly, we would very much appreciate it. Thank you and stay safe.